was prescribed on 11th May 2017, and this was actually a really an interesting ICDS which would have been easier for particularly builders and developers to follow. Real estate transaction ICDS 11. But though it was issued long back, about 5 years before, 11th May 2017, as we saw, we had initially accounting standards to be prescribed under section 145(2). Only 2 accounting standards were prescribed, and thereafter 10-15 years nothing happened. Same scenario now prevails. We have a draft ICDS issued on real estate transaction, but that has not still been a mandatory accounting income computing and disclosure standard. But interestingly, this ICDS 11 in draft form is directly in synchronization with the provisions of guidance note issued by the institute of our institute on real estate transaction issued in 2012. I am really a fan of this guidance note of the institute on real estate transaction, and one really can take good benefit of following this guidance note on real estate transaction. Had this ICDS 11 been properly notified, then for all builders and developers, percentage of completion method with whatever criteria would have been a mandatory thing. But as of now, it is not. So not required to be followed. I will elaborate on this when I go with construction contracts. So accounting for this first ICDS. Fundamental accounting assumptions, we see going concern, consistency, equitable or theoretical part. Consideration in selection and change of accounting policies. We can see the difference between AS1 and ICDS 1. AS1 says that you can consideration in selection of accounting policies to be prudent, substance or form and materiality. But here they say that the accounting policies should be such that they represent true and fair view of the state of affairs and income, and you can change only for this reason and not for anything else. Mark to market loss, I just discussed you. It says that mark to market loss or an expected loss will not be recognized unless the recognition of such loss is in accordance with the provisions of any other ICDS. And let me tell you, no other ICDS talks about mark to market loss. So therefore, mark to market loss, the example of which we discussed, is no longer an allowable proposition. The matter stops there. This is an example of expected loss, particularly in respect of a contract. What happens? I enter into a contract. There is no force majeure clause in the contract. I enter into a contract agreement with certain assumptions. I consider certain threshold raw material prices, and suddenly, when the contract is about to be started for execution, suddenly the prices of the raw material go up. Now, in such scenario, on the very first day of starting the contract, I know that I am going to be in loss because the raw material prices are substantially increased. So this is an expected loss, even though the contract is supposed it is to be executed over a period of 2 years. So the actual loss for the contract, in terms of figures, will come out in my books of account only in the year next, when I actually complete the contract. But today itself I know that this contract is going to be in loss because suddenly there is going to be increase in the raw material prices. So this is the scenario. What happens is that in the first year there is an expected loss of 5,000 rupees, but there is another contract where I earn actual income of 1,000 rupees. But because 5,000 is an expected loss, I cannot take into account while computing my income. I have to offer 1,000 rupees as my income, pay tax on it. And in the next year, there is actual loss of 5,000. There is actual income from another contract of 1,000 rupees. So computation of income is minus 4,000 rupees. But what do my books show? My books show 1,000 rupees only income, because 5,000 loss I showed last year in my books, because there is expected loss. So in my books, as per accounting standard, I showed that 5,000 rupees loss last year. So therefore this year computation is minus 4,000, but books plus 1,000, and there I end up paying MAT if I am liable to MAT. So sometimes the scenario may come that I may have to pay MAT only because of the provisions of ICDS with respect to mark-to-market losses or expected losses not allowed to be recognized. I can change the accounting policies only if there is a reasonable cause. Accounting standard 1 says that you can change it if it is required by any other accounting standard or required by statute or for better implementation. Now this was posed to the CBDT and FAQ 9 answers what is meant by reasonable cause, and I have this particular answer in front of you just to understand the mindset of the authorities. They do not answer what is a reasonable cause directly. What they say, reasonable cause is an existing concern evolved well over time, giving required flexibility to the assessors in deserving cases. So, at least I do not understand anything what is meant by reasonable cause by this answer. So, everything is now grey. What is reasonable cause? And therefore, it becomes very difficult as to how do I change my accounting policy. And if I change my accounting policy, for example, I am valuing my goods at say FIFO method, I want to change this to weighted average. So, whether that will be considered to be an allowable scenario or not becomes a problematic situation because reasonable cause is not properly addressed. Further, when you change the accounting policy and if the change does not have immediate effect in the year of the change, then the disclosure of change is required at 2 times. One, first in the year of change, and second, when the actual impact, also in the previous year in which the change has the material effect for the first time. So in both the cases you have to reflect. So this is ICDS 1. Now I am taking to ICDS 2 important things. WIP, what are the scope exclusions and what are the inclusions? Typically we value all these types of inventory, finished goods, WIP, raw materials and spares. Exclusions are producers inventories, then WIP for construction contracts. ICDS is WIP dealt with by other ICDS or shares, etc. And machinery spares to be capitalized. These are excluded from this ICDS 2. Now measurement, simple. Cost or net realizable value, whichever is less. Cost of inventories will include all these items, no need of much discussion. Purchase price, but here cost of purchases, our attention is required on this line, on the words which are being struck off, other than those subsequently recoverable by the enterprise from taxing authorities. We are talking about the input credit, exclusive method of accounting. So ICDS cost of purchase is says that you have to take it with taxes, including taxes and duties. So all gross basis, section 145A. And when you are going with this valuation, then abnormal vestige, storage cost, administrative and saving cost, they have to be excluded. All known to all of us, just to take you through proper ICDS. Cost formulas which can be used, specific identification method when a scenario of this. FIFO or weighted average, these are the 2 cost formulas we can use. And these are the 2 interesting that one we should know. One is the retail method which is allowed by the ICDS 2. Now what is retail method is what all you and me understand by retail method. That similar types of items, say cloth business, spares business, in such businesses the number of items are same, and inventory wise FIFO method or weighted average method also becomes problematic. In such scenarios, a retail method of valuation of inventory is apt and advisable also. What it says that inventory is of large number of rapidly changing items with similar margins, cloth business or spares business. Cost is determined by reducing the appropriate percentage of gross margin per sale. So you just have to take the inventory at the market price or the selling price. From that you have to reduce your gross margin, and whatever the net amount is arrived, that becomes your valuation of the inventory by retail method. And lastly, they are also allowing, the ICDS 2 also allow the standard cost method. Now the other is it possible for me to have 3 different cost formulas for 3 different categories of my inventory. Can I have a FIFO method for my raw material? Can I have weighted average for my work in process? And finally, can I have specific identification method for finished goods? In my personal opinion, this is possible, this is allowed. You can have different